Behind closed doors, top insiders are sounding the alarm. A $300 billion war with Iran could trigger an economic collapse no one in power wants you to know about. Not next year, not in theory, but fast enough to hit gas prices, markets, and the cost of living before most people even understand what's happening. Tonight on Macro Rewind, we're unpacking the financial chain reaction some advisors around Donald Trump have privately worried about. That a confrontation with Iran wouldn't just be a military gamble, it could be an economic shockwave. And if you want more breakdowns that connect global power to your daily life, hit like and subscribe, because what you're about to hear could reshape how you see geopolitics entirely. When most people imagine war, they picture soldiers, maps, and headlines. But inside policy rooms, wars are modeled very differently. Economists run projections. Energy analysts simulate disruptions. Treasury officials calculate borrowing needs. Because in modern conflicts, the first question isn't just who wins on the battlefield, it's who survives the bill. And when analysts model a large-scale conflict involving Iran, the numbers get uncomfortable very quickly. The reason is geography. Iran sits beside one of the most strategically sensitive energy corridors on Earth, the Strait of Hormuz. Roughly 1/5 of the world's traded oil flows through that narrow passage every single day. Any serious disruption there wouldn't just affect tankers in the Gulf, it would ripple through global shipping costs, manufacturing supply chains, airline fuel budgets, and ultimately the prices people see at the pump and in grocery stores. Energy markets react to fear almost instantly. Traders don't wait for full-scale war. They price risk the moment escalation looks possible. Even limited disruptions can send oil prices spiking in days, not months. And when energy prices jump, inflation follows. That puts central banks like the Federal Reserve into a difficult position. Lower rates to support growth, or keep rates high to fight inflation. Either choice carries consequences, and in wartime scenarios, those consequences tend to land hardest on households already stretched by borrowing costs. Then comes the second financial front, government spending. Wars are expensive not just because of weapons and logistics, but because of time. Even short conflicts create long tails of spending equipment replacement, veteran care, reconstruction, and interest payments on borrowed funds. Defense planners at the Pentagon understand that modern wars are often financed through debt, not taxation. That means the immediate cost isn't felt through higher taxes, but through increased federal borrowing that compounds over years. And the U.S. is already carrying significant debt levels. Adding hundreds of billions in new spending would likely mean issuing large volumes of treasury bonds. When supply of government debt rises sharply, investors demand higher yields. Higher yields push up mortgage rates, corporate borrowing costs, and consumer credit interest. Suddenly, the economic battlefield stretches from Washington to Wall Street to Main Street. This is where financial markets enter the story. Markets don't just respond to events. They respond to uncertainty. If investors begin to fear prolonged conflict, they often rotate away from riskier assets. Stocks can fall, volatility spikes, and safe haven assets surge. Even if the conflict remains limited, the anticipation alone can tighten financial conditions globally. And history shows that sharp tightening cycles, especially when combined with high energy prices, have often preceded recessions. There's also the international dimension. Conflict involving Iran would almost certainly pull other global powers into strategic calculations. Energy-hungry economies like China would face supply risks that could alter trade patterns. Commodity exporters like Russia might gain leverage in energy markets. Regional actors such as Saudi Arabia and Israel would adjust security postures in ways that could further unsettle investors. Once multiple major players shift simultaneously, global markets tend to interpret it as systemic risk rather than isolated conflict. For everyday Americans, the impact rarely feels geopolitical at first. It feels practical. Fuel costs rise within weeks. Airline tickets climb, imported goods become more expensive, insurance costs adjust upward as risk increases. Companies facing higher input prices either raise prices or cut hiring. Retirement portfolios tied to equities feel the volatility. The crisis doesn't arrive as a headline. It arrives as a slow squeeze on monthly budgets. Policy insiders often worry about timing more than scale. The U.S. economy can absorb shocks, but only if they arrive when growth is strong and inflation is low. When shocks hit during periods of elevated debt, sticky inflation, and political gridlock over spending, they become far harder to manage. A conflict layered on top of existing vulnerabilities can turn manageable stress into systemic strain. History offers some perspective here. The oil shocks of the 1970s triggered inflation that reshaped monetary policy for decades. The wars following 2001 expanded federal deficits for years beyond the actual fighting. Financial crises rarely come from a single event. They emerge when multiple pressures align at once. A major energy disruption, rising borrowing costs, and fragile market sentiment could form exactly that kind of alignment. That's why some advisors treat a potential Iran conflict less as a military scenario and more as a financial stress test. Their concern isn't just whether the U.S. could win militarily, it's whether the economic consequences would erode stability at home, weaken consumer confidence, and constrain future policy options. Because once markets lose confidence, restoring it is often far harder than maintaining it. None of this means economic collapse is guaranteed. Economies adapt, governments respond, supply chains reroute. But insiders think in probabilities, not certainties. Their worry is that a large conflict in a strategically vital energy region could hit at a moment when the global economy already has limited room for error. And when margins are thin, even a moderate shock can produce outsized consequences. So the real question isn't simply whether a war could be fought, it's whether it could be afforded financially, politically, and socially. Because wars today don't just redraw borders. They influence inflation, debt, markets, and living standards for years afterward. And by the time the economic effects become visible, the decisions that caused them are already locked in. If you think the financial side of geopolitics doesn't get enough attention, drop your thoughts in the comments. I read them all. Share this with someone who follows markets or policy, because these conversations matter most before crises unfold, not after. And remember, the biggest economic shocks in modern history didn't begin with numbers. They began with choices.